Welcome back to Old Men, New Money. I'm Davoudi, and today we're starting Module 4 of our educational series on digital securities. Over the past 3 modules, Douglas has walked you through digital securities fundamentals, blockchain technology for finance professionals, and then through corporate treasury strategies. Now we're diving into something different but equally important, real-world asset tokenization. And we're going to start with the most hyped, most discussed, and frankly, most disappointing category so far, real estate tokenization. I'm going to tell you why it hasn't worked yet. More importantly, I'm going to tell you what needs to change for it to actually work. Because real estate tokenization is not a bad idea. It's just been executed poorly so far. I have a unique perspective on this. I've been an angel investor in over 15 companies across multiple sectors. I own part of the Thayer Hotel at West Point. I understand both the investment side and the operational complexity of real estate. And I've watched dozens of real estate tokenization projects launch with great fanfare and then quietly disappear. So let's talk about what's real and what's hype. The promise that got everyone excited. Let me start with why everyone got so excited about the real estate tokenization in the first place, because the pitch sounds amazing. Here's how it goes. Real estate is the largest asset class in the world, over $300 trillion globally. But it's also incredibly illiquid. If you own a building, you can't easily sell 10% of it. You either sell the whole thing or you don't sell it at all. And for investors, accessing quality real estate deals has always been difficult. You need to be an accredited investor. You need significant capital. You need connections. And even then, you're often in for years with no ability to exit. Tokenization was supposed to solve all of this. Take a real estate asset, represent ownership as digital tokens on a blockchain, and then suddenly you have fractional ownership, 24/7 trading, global access, and instant settlement. Democracy of access to the real estate investment world. The pitch decks wrote themselves. Imagine owning a piece of a Manhattan skyscraper for only $500. Imagine being able to sell that stake instantly on a secondary market. Imagine dividends from rental income hitting your wallet every month automatically via a smart contract. Sounds incredible, right? Here's the problem. Almost none of that's actually happened at scale. So why real estate tokenization has failed so far? Let me be blunt. Real estate tokenization has been one of the biggest disappointments in the digital security space, and I'm someone who wants it to succeed. There are 3 fundamental problems that nobody talks about, honestly. First problem is regulatory complexity. Real estate tokenization projects thought they could just tokenize a property and start selling to anyone globally. Wrong. Every jurisdiction has different securities laws, different property laws, different tax treatment. If you tokenize a building in New York and sell to someone in Germany, whose laws apply? What happens when that German investor wants to sell to someone in Singapore? How do you handle tax reporting issues across multiple jurisdictions for potentially thousands of small investors? Most projects completely underestimated this complexity. They launched thinking blockchain somehow exempts them from securities law. It doesn't. You're still selling a security. You're still subject to the same regulations as any other real estate investment vehicle. Second problem is liquidity illusion. Projects promise secondary market liquidity. They build trading platforms, but having a platform doesn't create liquidity. Liquidity comes from buyers and sellers actually wanting to trade. And here's what happened. People bought tokens thinking they could flip them quickly, but when they tried to sell, there were no buyers. The secondary markets became ghost towns. Bid-ask spreads were massive, and suddenly investors realized they were just as locked in as a traditional real estate investment, except now with added technology complexity. Third problem is the value proposition wasn't clear. For the issuer, tokenization added significant cost and complexity with little benefit. They still needed to manage the property, handle tenant relations, maintain the building. Tokenization didn't solve any of their operational issues. For investors, fractional ownership of real estate already exists through REITs. REITs are liquid, they're regulated, they're tax advantaged, they trade on major exchanges with deep liquidity. Why would I buy a token representing a fractional interest in one building when I can buy a REIT that gives me diversified exposure to hundreds of properties? Nobody has had a good answer to that question to date. Though the structural problems that make it hard. Beyond those 3 big issues, there are 3 structural problems that make real estate tokenization fundamentally challenging. Property management doesn't benefit from tokenization. Whether you have 1 investor or 10,000 token holders, someone still needs to fix the roof, negotiate leases, handle maintenance. Tokenization adds a layer of complexity to investor relations without simplifying operations. Governance becomes a nightmare with fractional ownership. Do 10,000 token holders vote on every major decision? Do you have a lead investor or property manager with discretionary authority? How do you handle investor disputes? Traditional real estate partnerships limit this complexity by having a small number of sophisticated investors. Tokenization opens it up to thousands of small investors who may not understand real estate at all. Exit timing is another issue. In traditional real estate investing, the partnership decides when to sell the property based on market conditions and the investment thesis. With tokenized real estate and promised liquidity, you have investors exiting constantly based on personal circumstances, not property fundamentals. This creates pressure for liquidity that doesn't align with long-term real estate value creations. And then there's the cost problem. Tokenizing a property costs money. Legal structuring, smart contract development, security token issuance, regulatory compliance, investor onboarding, ongoing reporting, on and on. You might spend $100,000 to $500,000 just to tokenize a property. For a small property, that cost is prohibitive and neuters the economics. For a large property, traditional financing is cheaper and easier. Here are some examples that didn't work. Let me give you some examples of projects that launched with great fanfare and then struggled to disappear. There have been dozens of residential property tokenizations. Someone buys a rental property, tokenizes it, sells fractions to investors promising monthly rental income. Sounds great, doesn't it? But most of these projects found that managing hundreds of small investors was more trouble than it was worth. Recording requirements, answering investor questions, handling token transfers. It became a full-time job separate from actually managing the property. There were commercial real estate tokenization platforms that promised to tokenize office buildings and retail spaces. They raised money, built technology platforms, did a few pilot deals, but they really couldn't achieve liquidity. The tokens traded rarely, if at all. It was like a roach motel, easy to get in, hard to get out. And they realized they were competing against established commercial real estate investment firms that already had better deal flow, better property management, and better investor access. Some projects tried to tokenize real estate development projects. Investors could buy tokens representing equity in a property being built. This was supposed to democratize access to development deals. But development is risky. Projects take years, and even when some of these developments didn't go as planned, investors found themselves stuck with illiquid tokens and projects that were over budget and behind schedule. The international projects had it even worse, trying to tokenize real estate in emerging markets and sell to global investors. Different languages, different legal systems, different levels of transparency. Investors quickly learned that blockchain doesn't protect you from regulatory risk in jurisdictions where property rights aren't well established. I'm not naming specific projects because many of them are still operating in some form. But if you look at the volume of the real estate deals in the actual tokens trading, it's tiny compared to the hype 3 or 4 years ago. So what do we need to change for it to work? This means that real estate tokenization is dead? Is far from it. It means the current approach isn't working. We need different models. Here's what needs to change. First, stop trying to tokenize individual properties. The unit economics didn't work for single property tokenization. The regulatory and operational complexity is too high relative to the capital raise. Instead, tokenize real estate funds or portfolios. This gives investors diversification, gives managers economies of scale, and solves the governance nightmare of thousands of investors voting on individual property decisions. Second, stop promising secondary market liquidity that doesn't exist. Be honest about lockup periods. Real estate is an illiquid asset class. That's okay. Tokenizing it doesn't immediately make it liquid. Structure the tokenization around long-term holds, not day trading. If you want liquidity, build it through periodic redemption windows, not 24/7 trading on thin secondary markets. Third of all, focus on specific value propositions that actually matter. Tokenization for the sake of tokenization isn't compelling, but tokenization that solves a real problem is. For example, cross-border investment in institutional real estate has always been complicated. Tokenization could simplify that if structured properly with clear tax and legal framework. Fourth, integrate with traditional real estate operations. Don't try to rebuild everything from scratch. Partner with established property managers. Work with existing real estate legal structures using proven accounting and reporting systems. Add the blockchain layer where it provides the actual value, not everywhere just because you can and you want to say you're blockchain based. Fifth, wait for regulatory clarity. I know that's boring advice, but the reality is that until we have clear framework for cross-border real estate token trading, clear tax treatment, and clear investor protection rules, real estate tokenization will remain niche. The regulators are working on this. Give them time to get it right. The models that might actually work. Let me give you three models I think have potential. Model one is institutional real estate fund tokenization. Take an established real estate fund with a proven track record. Tokenize the fund shares instead of individual properties. This solves governance, provides diversification, maintains professional management, and gives tokenization scale advantages. You're not trying to explain real estate investing to retail investors. You're giving institutional and qualified investors a more efficient way to invest in funds they've already understood. Model two is tokenized REITs. Why shouldn't REITs issue tokenized shares alongside traditional shares? They already have the regulatory framework, the property management, the investor relations infrastructure. Add tokenization to enable 24/7 trading, fractional ownership below current minimums, and programmable dividend distribution. This doesn't replace REITs, it enhances them, it makes them more efficient, and brings them into the 21st century. Model 3 is tokenization for specific pain points in commercial real estate transactions. For example, syndication deals where multiple investors co-invest in a single large property. Tokenization could streamline the capital raising, automate the waterfall of distributions, and provide transparency on property performance. You're not promising magic. You're just making existing processes more efficient. Notice what all three models have in common. They're not trying to reinvent real estate investing. They're taking existing proven models and adding tokenization where it provides actual operations or efficiency benefits. My personal takeaway from these real estate projects, I've looked at dozens of them. Real estate tokenization projects, all of them as a potential investor, and I've passed on all of them so far. Here's why. When I evaluate investment, I ask simple questions. Does this involve a real problem? Does it have a sustainable business model? Is the team capable of executing? Does the regulatory framework support it? Can I exit if I need to? Most real estate tokenization projects failed multiple parts of that test. They were solutions looking for problems. The problem they claim to solve, lack of access to real estate investing, isn't actually a problem for most investors. REITs, crowdfunding platforms, and traditional partnerships have already provided access at different capital levels. Their business models didn't make sense. High upfront costs, low ongoing revenue, complicated operations. How does the platform make money? How does it scale? Many didn't have good answers. And the exit question was always fuzzy. Sure, you can sell tokens, but to whom and at what price? With what transaction costs? When I pressed on this, the answers were always vague promises about future liquidity. Compare that to how I think about my other major real estate investments. I own part of the Thayer Hotel at West Point through a traditional partnership structure. I know exactly how the property is managed, who's responsible for operations, what the cash flow looks like, what the exit strategy is. It's not tokenized. It doesn't need to be. Tokenization needs to provide value beyond novelty. Here's where I think real estate tokenization could still win. Despite everything I just said, I'm not bearish on the real estate tokenization long term. I'm bearish on the current execution. These are the scenarios where I think it could work well. International commercial real estate investment is still complicated. If you're a European investor wanting exposure to U.S. commercial real estate, the process involves multiple intermediaries, currency conversions, complex tax structures, whereas tokenization could simplify this if the regulatory frameworks align. Real estate debt tokenization might work better than equity. Lending against real estate is more standardized than equity ownership. You could tokenize mortgage notes, construction loans, or mezzanine debt. The cash flows are more predictable, the legal structures are better established, and the market might even be deeper. Luxury asset tokenization could be a niche. High-end resort properties, landmark buildings, trophy assets, they have brand recognition and investor appeal beyond just cash flow. Fractional ownership of the Plaza Hotel or Pebble Beach could work if structured as collectible assets with some income component, not just pure real estate investing. And emerging markets might leapfrog developed markets. In countries where property rights are being digitized for the first time, starting with tokenized ownership from the beginning might be simpler than trying to retrofit tokenization into existing systems. But all of these require time, regulatory clarity, and realistic expectations about liquidity and returns. What's the lesson for the other asset classes? Real estate tokenization experience teaches us lessons that apply to tokenizing any real-world asset. Lesson 1. Technology doesn't really solve regulatory complexity. Blockchain makes it easier to track ownership and automate processes. It doesn't make securities law or property laws disappear. You still need legal structures that work across jurisdictions. Lesson 2. Liquidity can't be forced. You can build a trading platform, but that doesn't create liquidity. Liquidity comes from supply and demand. from market makers willing to hold inventory, from enough participants that buyers and sellers can find each other. Most tokenized assets don't have that. And lesson 3, the value proposition has to be clear for all participants. For tokenization to work, it needs to benefit the issuer, the investor, and the ecosystem. If it only benefits one party, it won't achieve sustainable scale. Lesson 4, start with proven models and add tokenization where it provides real value. Don't try to rebuild entire industries from scratch just because you put it on a blockchain. These lessons will apply as we discuss tokenizing other asset classes in the next 3 episodes. Keep them in mind. What you should do as an investor. If you're evaluating real estate tokenization investments, here's my advice. Be extremely skeptical of promises of liquidity. If the platform shows you volume statistics, dig into them. Is that real trading, or is that just shuffling between affiliated wallets? What's the bid-ask spread? How long does it take to actually exit at a reasonable price? Understanding the legal structure completely is very beneficial to the investor. Who actually owns the property? How are token holders' rights protected? What happens if the platform goes bankrupt? What happens in a dispute? These aren't hypothetical situations. These are things that have happened, and they happen continuously and will continue to happen continuously. So look at these fees carefully. There's often a stack of fees: issuance fees, platform fees, transaction fees, management fees, performance fees. Add them all up, compare that to what you pay in a traditional real estate investment. Often tokenization is more expensive, not less. Ask about property management experience. If the team's background is all blockchain and technology with no real estate operations experience, that's a red flag. Real estate is an operational business. Technology is just a tool. And finally, ask yourself honestly, why do I want this investment? If the answer is because it's on a blockchain or because I might be able to flip it quickly, those are bad reasons. Invest in real estate for real estate fundamentals: location, cash flow, long-term appreciation potential. If tokenization happens to be the vehicle, fine, but don't pay a premium just for the tokenization process. Looking ahead to the next episodes. Real estate was supposed to be the killer app for asset tokenization. Hasn't been. But that doesn't mean all real world asset tokenization is failing. In the next episode, we're going to talk about tokenized treasuries, treasury bonds, government debt instruments, stable value investments. This is actually work BlackRock's BUIDL, BUIDL fund has over $500 million. We're going to talk about why this succeeded when real estate did. Then we'll cover tokenizing public equity. This is starting to happen. Galaxy Digital tokenized their equity on Solana. We're seeing the first examples of 24/7 equity trading. What does this mean for markets? What does this mean for investors? And finally, we'll tackle private equity tokenization. This might be the most interesting category. Private markets are massive but illiquid. Could tokenization actually solve that problem? We'll see. Real estate taught us what doesn't work. The next 3 asset classes will show us what might. In closing thoughts, I want to end with this. My skepticism about current real estate tokenization doesn't mean I think it will never work. I think it will eventually work, but it's going to take longer than people thought. And it's going to look different than people expected. And it's going to start with institutional applications before it reaches retail investors. That's okay. That's how most financial innovation actually works. It doesn't happen overnight. It happens gradually as infrastructure builds and regulations clarify, as market participants figure out what they actually creates value and what doesn't, versus just what sounds good in the pitch deck. And as an entrepreneur and investor, I'm learning that timing matters. Great ideas at the wrong time fail. Good ideas at the right time succeed. Real estate tokenization might be a great idea that's still waiting for the right time. Question for you as an investor or an entrepreneur is, can you afford to wait? Or do you need to be working on something that's ready to work today? I'm Davoudi. This is Old Men, New Money. If this episode saved you from making a bad real estate tokenization investment, share it with someone who might be considering one. And on our next episode, we're going to talk about tokenized treasuries and the real-world asset tokenization category that actually works. Until then, talk to you soon.